How did you guys find the midterm exam? Is it okay? Good. You see, I knew you did well. It wasn't too bad. Hopefully, you know, the whole goal of the midterm exam anyhow, if you think about it, it's a low percentage of your overall grade. And the whole goal of it is really to get you guys studying, get you prepared, so that you don't just start studying a week before the final exam, right? So that's happened. Hopefully you guys have a good feel for kind of what the exams look and feel like, and then the final exam will be, you know, sort of a similar sort of format. And as you can see, my goal isn't to make it too hard on you guys. You know, if you do the work, if you've revised, if you've studied, you should be able to answer the questions just fine. So anyhow, we are on to a new topic today, interest rates and swaps. So that's going to be our new, the new thing we'll learn about. So we've got kind of a couple of derivatives. I just put this slide together about an hour or two ago before coming here, because I presume if you guys have been following the news at all, you know, we've had pretty dramatic moves in the markets today. We have oil down about 20% as of the open this morning, which is, you know, worrying for a lot of big companies, except of course the ones who need to buy oil. Good for them. You know, what else have we got? We had a huge fall in the S&P futures overnight. It went limit down, 5% down. So that's, you know, when we learned about, you know, limits in, I think it was our first class, we learned that, you know, there's a tighter overnight limit than intraday limit. So it actually went limit down rather quickly in the overnight market. It then fell a little bit further. They halted the market up near the open. It's rallied a little bit now, and as long as it doesn't fall 20% today, it'll continue to trade, you know, which hopefully is unlikely. So that is kind of what's going on. If we look up here, you can see this is today's, at the open of the market, the level of the VIX index. You know, we look back to like 1998 for similar spikes. This was the Fukushima reactor meltdown in Japan back in 2011. And so really the biggest one, other than these types of spikes, is the credit crunch, Lehman Brothers meltdown back in 2008. So kind of a dramatic market for you guys to maybe pay a little bit of attention to over the next few days. So anyhow, today we'll be looking at chapters 12 and 15 in your textbooks. So interest rates. So the big thing we're going to talk about today is kind of, we're on to kind of fixed income type derivatives. The first thing we're going to talk about is interest rates. Now, you guys have covered this sort of thing in other classes, so I don't have to go on too much about it, but we'll just do a very quick primer on interest rates. So obviously interest rates factor into nearly all derivatives, and they really factor into every financial, every sort of, what do you call it, financial decision, right? Because essentially, you know, almost the most fundamental equation that you learn in finance is this idea of discounting cash flow. So obviously, interest rates are a big deal in everything in finance. They're built into all of our derivatives. And they're things that, you know, they're a risk that people are exposed to, and they affect the pricing of all sorts of things. Now, the applicable rates will depend on the credit risk of the borrowers, right? So the riskier a loan is, usually the higher the interest rate is. And hopefully that makes sense to you guys. If you think about it, if you were going to lend money to one of two businesses, and one was a very low risk business and the other was high risk, you'd obviously prefer to lend your money to the low risk business. And it's really only if the high-risk business offered you quite a high interest rate that you would consider lending to them, right? Because that just makes sense. You have to be compensated for the risk that you're taking. And so what we're talking about there when we talk about different interest rates being associated with different level of risk is this idea of a credit spread. And basically, the credit spread is calculated based upon how much additional yield an investor expects for taking additional risk. So we're basically going to look at some sort of risky security, some risky loan, and compare it to a risk-free loan, which would be something like a government bond. There are a bunch of different measures of credit spread, which I imagine you've probably covered already in a fixed income class, so I'm not going to go on too much about it. But there are a bunch of different ones like Z-spread and option-adjusted spread, and they all just take into account the various options that might be built into a loan or into a bond. So for example, a lot of loans can be prepaid early. Like if you look at things like mortgages, when someone borrows money to buy a house, if they sell the house before the loan is fully paid off, they're usually able to prepay that loan. Now equally, if they borrowed money when interest rates were high and interest rates fell, you're often able to refinance that loan. So once again, that has sort of an option-like nature to it. If you think about it, if interest rates go up and up, you'll obviously hold on to your low interest rate loan, while if interest rates fall, you'll quickly prepay that loan in order to take out a new one at a lower rate. And so that is, that's one of the kind of options that can be built into a loan. Now the next little slide we're just looking at for a moment, it's just a quick reminder to you guys about interest rates and bond prices. So whenever interest rates go up, bond prices go down, and whenever interest rates go down, bond prices go up. And hopefully that just makes intuitive sense to you. If you imagine if you were, if you worked at a company where you issued a bond, and we'll say you issued a bond that paid 5% interest, and the next day something happened and interest rates went up, okay? So now a similar bond would maybe yield 5.5%. Well, if that bond is out there in the market and one person owns it and they want to sell it to someone else, that's obviously going to be unattractive to buy a bond that yields 5% when the going rate is 5.5%. And the only way that you'll be able to sell that 5% bond is to mark the price down on that bond. And you'll move the price down until the bond now yields 5.5%, right? Which is the going rate of interest in the market. So, and then the opposite, of course, happens with if interest rates go down, bond prices go up. And so this is just sort of a basic idea that I'm sure is not at all confusing to you guys, but it's equally worth taking into account when you look at all sorts of investments that might be bond-like. So for our interest rate sensitive investments, we'll even say, so things like a portfolio of high dividend stocks, if interest rates get cut a lot, maybe high dividend stocks become more attractive to investors, for example. Another thing is, of course, things like home prices, right? Because most people who buy a home are borrowing money in order to buy a home, right? They go to their bank and they say, I wish to buy a house. You often don't turn up at the bank and say, I want to buy a £500,000 home. Instead, you go into a bank and you say, I earn this much a month, how much can I borrow? And the bank says, well, when you pay for food and other household expenses, you have £2,000 a month left over. And so if we take that £2,000, look at the going interest rate, that then means that you're able to borrow X amount of money. And once you know that, then you go out shopping for a house in that price range. And so, therefore, when interest rates go down, it means that you're able to borrow more money because that amount of income that you're making is able to service a larger mortgage than if interest rates go up. And so often you'll see things like, when interest rates go down, house prices go up, and when interest rates go up, which I imagine many of you think they can never do, but of course they just got cut the other day. But, once in a while, maybe theoretically, interest rates could go up, and of course, that would be harmful to people who borrowed money in order to buy a home. Now, in different parts of the world, home mortgages work quite differently. So, in the UK, you usually can't borrow at a fixed rate for, say, 30 years, which might be the length of a mortgage, right? And so often you just lock in the first couple of years at a fixed rate, and after that it becomes floating. Now in other countries, in the United States for example, you're able to lock in a 30-year mortgage at a fixed rate. That kind of means that we'll say, for example, the Bank of England has much more of an impact when they start moving interest rates around, simply because if everyone's mortgage is tied to the interest rate you're moving around, you're really taking money out of or putting money into people's pockets when you increase or decrease interest rates. Hopefully that makes sense to you. And so that's kind of why these rate cuts or rate hikes are stimulative in the economy. So where are we going from this? So there are a whole bunch of different types of interest rate. We need to talk about a few of them in order to get to the new derivatives that we'll be learning about today. The first one we'll talk about are sovereign rates. And sovereign rates are the rates at which governments are able to borrow. And we usually talk about sovereign rates in terms of what a government can borrow in its own currency. Because of course sometimes countries will issue bonds in a foreign currency. That's usually considered a riskier loan. Does anyone know why that's a riskier loan? Because the exchange rate can change, right? So the exchange rate can change, and therefore it might be more difficult for the country to pay off that loan. Are there any other reasons it might be risky? Exactly. So if Britain issued a bond in US dollars and suddenly they were having difficulty paying that bond off, they can't print US dollars to pay off that loan. Well, of course, they can print British pounds to pay off that loan, right? So in terms of getting paid back the money, now, of course, if you're printing money, that might depreciate the value of the money on an international market, but the fact still remains that they will pay off that bond because they're both able to tax in their home currency and they're able to print their home currency if they need to. So there's not really a good reason for a country to default on its own currency bonds. Now, just because there's not a good reason doesn't mean that that never happens. It's worth noting. So actually, if we go back to our VIX chart, where was that? Back here. Does anyone know what caused this big spike back in 1998? Pardon? No, that was 99. No, it's actually Russia. Russia defaulted on their bonds in the Russian ruble denominated bonds, and that caused a big, what can I say, sort of shockwave across markets, which then went on to cause the largest hedge fund in the world, a fund called Long-Term Capital Management, went bust basically. They lost significantly more money than they had in the fund. Ended up having to be bailed out by the US banking system. It almost caused the US, in fact, if you look at banking stocks back then, you see things like JP Morgan, down 80% in a few days over this sort of thing, So it was a very big deal at the time, and that was the Russian debt default. So what else have we got here? So Libor then, we've got Libor up here as the next rate. I imagine many of you have heard about the Libor scandals in recent years. Have you heard about the Libor scandal? And so, of course, Libor, it stands for London Interbank Offered Rate. And it's a rate at which banks will lend to each other after this period. Now, does anyone know how they calculate Libor, or does anyone have a bit of an idea as to how it works? Pardon? Exactly. It's an average of the bank's rates that they say they'll lend to each other, but it's not necessarily something that they observe in the market. They call around the various banks and say, how much will you lend to other banks at? And so, of course, that's how the whole fixing scandal came about, is there's maybe a dozen people who answer that phone call and give the answer, right? Because Libor wasn't designed to be such an important rate. It was actually really just designed in order to be something printed in the newspaper, right? It was meant to be of general interest, and suddenly every derivative in the world was based upon it. And so there were all sorts of problems around LIBOR, and so they've now decided to get rid of LIBOR. And they're going to replace it, or they're likely to replace it with what's called SOFR. Now this isn't set in stone yet, but next year we will know. The FCA is no longer compelling banks to submit LIBOR quotes after 2021. And LIBOR will be replaced by what they call an ARR, which is an alternative reference rate. They haven't, it's not set in stone as to what they'll choose, but it really looks like it's going to be SOFR. SOFR is quite different to LIBOR, because LIBOR isn't one rate, it's a whole bunch of different rates. It's different floating rates for different expiration periods, right? While SOFR is also, LIBOR takes into account the credit risk of banks, while SOFR doesn't. And it's an overnight rate rather than these more long-term rates that LIBOR is made up of. And so that, of course, will cause all sorts of problems in adjusting derivatives to take this into account. But basically, the reason they're moving to this is that this is a market-determined interest rate, okay? So this is a rate that can be observed in the market that people are lending and borrowing at, while LIBOR was just a quoted rate, and that's sort of the problem with LIBOR. So that is, so LIBOR and SOFR are essentially what we call floating interest rates. So we've got these longer term kind of locked in interest rates. There might be, you know, the 10-year government bond or something like that. And then we've got these short term floating rates, and they kind of change every day. And so both of these two things are quite different. So the next thing then we have is what's called the repo rate. Have you guys heard of repurchase agreements already? So repurchase agreement, when I first learned about these, I didn't really understand how it was classified as sort of a fixed income security like a bond, because it doesn't sound like a bond, right? Because a repurchase agreement is an agreement to sell securities and to buy them back the next day. And at first you might think, well, that's the sale and repurchase of securities. That's different to an interest rate. But when the price that you're buying them back at the next day is pre-agreed upon, it essentially just means that it's an overnight loan where you're selling and rebuying your security. You're essentially handing over a basket of investment securities as collateral on this loan. Does that make sense to you guys? And so therefore, the repo rate really is just high-grade overnight borrowing, and it's just a collateralized loan. It's the best way to think of what repo actually is. Longer-term arrangements like this do exist, and they're referred to as term repo. So there's the repo rate, and then there's term repo. So what else have we got? So then finally we get to this idea of the risk-free rate. And, you know, as the slide says, technically there's always sort of some sort of risk with a loan, like the example being given earlier of Russia defaulting. And, you know, countries do default, you know, frankly, all the time. Well, not all the time, but from time to time. But most sovereign risks are considered risk-free when they're same currency loans and they're able to raise taxes in that currency. So that's kind of what we're talking about with the risk-free rate when we talk about discounting something at the risk-free rate. So finally, we have a little compounding reminder. And of course, I don't have to tell you guys about this because you prepared all this sort of stuff and you got good at using your calculators for the midterm exam. But we can compound things differently, annually, semi-annually, quarterly, or continuously. And if we do that, we will get a different number at the end, as you can see. And so it's sort of important to pay attention to how something is being compounded. And I think this is one of the last sort of little interest rate slides we have. But this is zero coupon bonds. And so zero coupon bonds are bonds that don't pay a coupon over the life of the bond. Now, do you guys know what I mean when I say a coupon? So a coupon, bonds in sort of the really old days used to come, you'd get a big sheet of paper that was a bond, and it would have a whole bunch of little coupons at the bottom that you could cut out with a scissors. And you would, as the date came up on those, you could deposit those and you would get cash in exchange for them. Like, that's why it's called a coupon. It was a physical coupon. And so each of those coupons would be an interest payment that you receive. So you receive occasional interest payments, and then finally the full amount, which would be the last coupon plus the principal amount. Now, zero coupon bonds don't work like that. They're issued at a discount and usually redeemed at par. And so you buy a zero coupon bond, and we'll say if it's, in this example, if you put $100 into a 5-year zero coupon bond, where the rate is 5%, you basically get nothing for 5 years, and then in 5 years' time you get $128.40 back for every 100 that you put into the bond. So it's all principal and interest all at once. And that's actually a very useful thing within the world of fixed income, simply because that really tells us what the actual interest rates are, right? Because if we think about it, let's see if I have a mark here. So if we think about a regular bond, oh, they never have ink, do they? Let's see. Oh, there we go. If we think of a, what's that, 1, 2, 3, 4, 5-year bond, right? And you receive, we'll say, $5, $5, $5, $5, and 105, right? If those are coupon, principal and interest, right? If you receive that, the problem is, that's not a good description of what the 5-year interest rate is, because this one will be discounted at 1 year, this one at 2 years, this at 3, this at 4, and finally that at 5 years, okay? That's the kind of what you're getting. And so we don't fully know with a bond like that what the 5-year interest rate is. But with a zero coupon bond, we do know, because you only get one payment and you get it in 5 years' time. So zero coupon bonds allow us to work out what very precise interest rates are for very precise lengths of time. Does that make sense to you guys? So this one here, this coupon paying bond, would be sort of a weighted average of all of those different interest rates, while the zero coupon bond is just the interest rate. So where do we go from there? Well, so you're able to then back out, expected interest rates from zero coupon bonds, but no, hold on, that's not what this slide says. Sorry. So when you're pricing a regular coupon paying bond, what's actually happening is that we're taking each coupon and discounting it at its appropriate interest rate. So this first coupon is being discounted at the half-year interest rate, the next one at the 1-year interest rate, and the final one at the 1.5-year interest rate. Does that make sense to you guys? It's kind of what I just said here. But when we have zero coupon bonds, the cool thing that we're able to do is we're able to back out implied interest rates, right? Because if we know the interest rate for 1 year, and we know the interest rate for 2 years in securities with similar risk, we're able to back out what people think the 1-year interest rate will be in 1 year's time. So let's have a quick look at what I'm saying. That's quite a mess I made. Well, anyhow, so if we know the 1-year interest rate, the interest rate that covers this time period, that's 1 year, and we know the 2-year interest rate, which is this one here, what we're able to work out is what people think the 1-year interest rate will be in 1 year's time. Does that make sense to you guys? And we're able to back that out because the idea should be that if both of these, we'll say they're both government-issued securities, they're risk-free rates, right? If we're able to believe that, then it's reasonable to think that the amount of money you get for putting your money in the 2-year bond should be about the same as the amount of money you get for putting your money in a 1-year bond, and then when you get it back in a year, putting it in for another 1 year, right? So that is then what we call a forward rate, and it's an implied interest rate that we just back out prices that are existing in the market right now. Does that make sense to you guys? So that's what we call a forward rate. It's the rate, the fair interest rate that you could agree upon today to borrow or to lend that for a year and 1 year's time, okay? So, and the idea is that you can kind of get exposure to this without even derivatives, right? Because you can, for example, go long the 2-year bond and short the 1-year bond, and that will give you exposure to the 1-year interest rate in 1 year's time. Does that make sense to you guys? And so, therefore, if someone offered you a different rate to that for 1 year and 1 year's time, you have an arbitrage opportunity in theory. So, and once again, there is a YouTube video on this very topic. And so, a forward rate agreement is a derivative that is an agreement to borrow or lend during a specified period of time, not starting now. Does that make sense? So that's just a forward rate agreement. So rates in the future will work out differently, right? And that's just the way things work. Is that often, just because something is the implied fair rate, of course news can happen, right? Like you can imagine a week ago, whatever the implied fair rate was to lend at some point in the future will have changed simply because there's been huge moves in the bond market, huge changes in volatility, all sorts of things have happened in the last week. And so if you made a bet on that, you would likely have been wrong, right? But it still is the sort of arbitrage-free rate at that point in time. So if you enter into one of these things, they're most likely, unless it really works out exactly as expected, there will be gains and losses, and it just depends on how you do it. So if you agree to lend 100 million for 6 months, starting in 2 years' time, to earn a 3.5% return, after 2 years, we'll now know what the 6-month interest rate is. So in our example, we entered into this agreement to earn a 3.5% return, but after 2 years, you realize that you could have, what are we doing? We're lending, you could have lent at 4%, right? So have you made or lost money there? You've lost money, right? Because you could be lending at 4%, but instead you entered into an agreement where you agreed to lend at 3.5%. And so how much would it cost you to get out of that agreement? Well, it would be the difference between 3.5% and 4% for, what did we say the length of time was? For 6 months' time, right? So in our example up here, it'll be 250,000. If you wanted out of that agreement, you'd have to pay $250,000 to get out of that agreement. So that's the loss you would have taken. Now, in our forward rate agreements, we're using non-continuous compounding in order just to make it kind of easier to understand. So that's forward rate agreements. They're not very complicated, right? It's just an agreement to either borrow or lend at some point in the future, not starting now, and we're able to back out the fair rates, the correct prices to do that on, just based on these zero coupon bonds which are out there. So the next derivative we have, and it's kind of, we'll spend, I think, the rest of the class on this topic, is a swap. Have you guys heard of swaps already? And do we like swaps or do we hate swaps? What do we think? I can tell this girl has a strong opinion on swaps. She's not going to say it. But often there's a lot of people who they sort of hate swaps. They hate swaps because they think they're complicated. And so I'm delighted to tell you guys that they're not complicated, okay? The beauty of swaps are, like if you look at the options that we just covered in prior classes, all of the complex formulas, and I think it took us 4 classes to understand options, with different formulas and so on. And we're still going to, I think a week or so, we're going to be learning one more approach to pricing options, which is the Monte Carlo method. But with a swap, it's actually quite easy to price. So let's just think firstly about what a swap is. So a swap is a financial derivative where 2 parties agree to swap 2 sets of future cash flows, okay? So I'm going to imagine we've got these 2 people here in the front row, and these are the best 2 students in the class. And I know that many of you are thinking, I can see there's a few angry people back in a few students, and they're like, that's not true, I'm the best student. But I know that these are the best 2 students, and it's not because I've actually seen the midterm exam papers. It's just because they're sitting in the front row, and that's the way it works, And so And there's people over here, they're in the front row as well, but they're sort of further from the center, which is worse because they're kind of trying to avoid getting asked questions. So anyhow, we've got our best two students here, and we'll imagine after the class, because they're the best two students, they hang out together and they talk about derivatives all the time, because they're trying to get the best grades in the class. They sort of hate each other as well because they're competitive. But anyhow, they go out after the class for a few drinks, and they start talking, and a few more drinks, and one says to the other, you're the best student in the class, and the other student says, no, that's not true, you're the best student in the class, let's have another round. And so they have a few more drinks, and this argument is going on and on, okay? And so by the end of the night, they haven't yet settled who's the best student, but we'll say this guy here, he says to this girl, he says, I'll tell you what, I have so much faith that you're the best student in the class that I want to enter into an agreement with you. Over the next 5 years, what we're going to do is we're going to go out and we're going to get the best jobs that we can get, and then what we'll do is we'll exchange our paychecks for each other's, okay? Because I'm so sure that you're going to be the best student that I'm willing to make that bet, So that's the agreement they enter into. They sign a little document. They have a lawyer present because that's the kind of place they're hanging out at. And they have an agreement, and that's a swap, okay? It's a simple agreement to exchange two cash flows, and two streams of pay are two cash flows, and they've agreed to exchange those for a fixed length of time, which is 5 years. And they're going to meet up once a month and just sign off the paychecks to each other. That's all a swap is. How would we price that? What do we think? How could we price that on time zero? It's very difficult at time zero because we don't really know, but we'll imagine that they are the best students in the class, and so they're likely to have similar incomes going forward, right? And they both feel that it's a fair exchange, so no one has to pay anyone to get into this agreement because at time zero, at inception, the two cash flows are equal, okay? Now, in 6 months or a year's time, when they've both gone out and got jobs, that's suddenly when we might be able to reprice this swap, right? And so one of them, we'll imagine that this guy here, he goes out and he gets a job and he's a managing director at Goldman Sachs. He's got a big job and he's going to be very successful. Now this girl here, because she actually is smarter than him, decided that she doesn't have to work that hard, right? Because she's going to get his paychecks. And so she just sort of gets a job at McDonald's, She's not the corporate part of McDonald's, the restaurant, So she's cooking the fries, things like that. She's not even doing a good job. She doesn't really care. And so after a few months, he's kind of getting annoyed, right? Because he's working at Goldman Sachs, but he doesn't really make very much money. He's got like 8 different roommates and things like that. Well, she's working at McDonald's, but she arrives at McDonald's every morning in a Lamborghini because she's entered into a really rather good financial agreement. And so how would they get out of this agreement? How much would this girl charge this guy to get out of this financial agreement?
Why would she want to get out of this agreement?
Sorry, how much? Well, she would have to charge him. The only reason she would agree to exit is, of course, if he paid her something, right? So how much would we, could we calculate a fair rate?
What difference is?
It's the difference in the paychecks present valued over 5 years, right? So all we have to do is look at the present value of the two cash flows, and the difference between them is the value of the swap, right? And so that's all the swap is. We've got two cash flows, we present value them, and the difference between those two present values is the value of the swap. And it just depends on if you're receiving, which one you're receiving and which one you're paying as to how you price that swap, okay? As to whether you're up or down on that swap. That's all there is to it. And so that's what a swap is. It's not complicated. And if ever you're kind of working on a swap question and you're saying to yourself, this is awful, this is complicated, just remember, all it is two cash flows. You know how to price one cash flow, and if you know how to price one cash flow, you know how to price the second one. And then it's just the difference between them. That's all we have to do to price a swap. So it's not that complicated.
But I still don't understand why would somebody do that?
Well, they might not do that. I had to add an awful lot of alcohol to that example to get it to work. But in the real world, maybe you wouldn't want to swap your paychecks like that. And of course, there's all sorts of problems, like the fact that neither person is necessarily incentivized to work that hard. We'll say with that example. But what if it's two bonds? If we're swapping the payments up for one bond for the payments of another bond. That's a swap, right? And you'll find that actually that's a much more popular swap than these drunken agreements of paychecks, you know? So, a swap is just two people swapping, exchanging the cash flows of one financial instrument for another, okay? And so then we can have all sorts of swaps, right? Because there's as many financial instruments as exist, we're able to swap one for the other, okay? So let's look at an example. Interest rates. So these are interest rates. They're a couple of weeks old, so they'll have changed hugely by now. But we've got here, in the United States, you're able to borrow at a fixed rate for 30 years, or you can borrow at a floating rate. And I pulled these interest rates a little while ago off the Bank of America website. And so you can borrow at 4% floating or at 4.5% fixed. Now, which is the best one? Which should we pick if we're going to borrow money to buy a house?
Fixed.
Fixed. Why fixed?
Because you can calculate your costs.
That's an excellent answer. So it's basically the sort of hedging argument, right? And that's usually, people like to borrow at a fixed rate simply because usually their paychecks are within reasonable bounds kind of fixed, right? When a lot of people, once they, in the first few years of your career, you possibly earn more and more and more, and then after a while, your earnings go up sort of with the rate of inflation, we'll say, right? So, and they certainly won't go up just because interest rates go up. You can't go to your boss and say, the base rate on my mortgage has gone up by 2%, can I have a big increase in my pay, right? It doesn't work that way. So usually people do like to borrow at a fixed rate, right? Because you can just make longer term plans. Now, although people might like to do that, banks, at least traditional banks like a savings and loan type bank, would usually take in money in terms of deposits, right? People deposit their money at a bank, and do they lock their money in for 30 years when they deposit it at the bank? No, they usually get kind of a short-term floating interest rate, right? And so the bank might be unwilling to lend to you for 30 years fixed if they're paying a floating rate on the cash that they're borrowing from the public in terms of deposits, right? So a swap allows a bank to be able to pay a floating rate on the borrowings that they do, swap it into a fixed rate, and then lend to a customer at a fixed rate, right? So swaps allow this type of economic effect to occur, where they're able to lend at a fixed rate for 30 years. Does that make sense? And so that's actually quite a useful derivative. Now let's think a little bit more about these rates just to get everything square in our head. So if you thought that interest rates were likely to go up, which of these rates would you want? No, because you're borrowing, right? You'd want the fixed rate. And if you thought rates were likely to fall, you might then want the floating rate. So it's also worth thinking that while this is kind of a hedge, in that it works as a hedge for a bank in order to convert one type of security into another, it also is a way of speculating on whether rates go up or go down, because you'll obviously, with one leg or the other, you'll profit as rates go up or go down. So once again, with swaps, kind of like with all of our financial derivatives, there's a few ways of looking at them. One is that we can be a hedger, and another way is that we can be a speculator. And so as you can imagine, there's a lot of both in the world. Now this is a slide I just threw in for sort of general information purposes, because a lot of people haven't seen this sort of thing, or at least haven't paid attention to it. This is interest rates since, what year? It's maybe since 1970 till present. And so as you can see, interest rates, and actually because of the oil shock yesterday and the coronavirus and all of these other things going on in markets, interest rates are today at a historic low. They've never been lower than they are today, right? And so, but back here in 1980, we had rates close to 20%, right? So your parents possibly, when they borrowed money to buy a home, had to pay 20% interest on it, or lock that in for 30 years. Now, of course, you're able to refinance as rates fall, which is kind of lucky, but it's worth thinking about when people ask, like, why do house prices go up, or why have they gone up so much since 1980? One of the reasons is that interest rates have come down. And so when you go to a bank and you want to borrow money, you go in and you say, well, I've got $1,000 a month that I'm going to spend on my mortgage, right? And if interest rates are 20%, $1,000 a month doesn't buy you an awful lot of house. But as the rates come down and down, it actually means that you can borrow more money. And if everyone can borrow more money, instead of it just meaning that everyone moves into a bigger and better house, all that happens is house prices go up, right? And so there's a lot of investment type products that we describe as interest rate sensitive, and they are things that you would expect to go up in value if interest rates go down. So an example, like a sort of side story, and this was many years ago, when I was probably about your age, I bought my first home, and at the time I locked in an interest rate of 8.5%, which seemed quite good. It was the long-term average interest rate at the time, And then about 6 months later, September 11th happened, and interest rates came way down, and I was able to refinance. Now, I only owned that home for about 2 years, but not so long ago, I looked it up. I typed in the address because you're able to see the price of everything, and I saw the guy I sold it to had kind of doubled his money on it, and that's not always delightful. I should have doubled my money. No, I am. But I at first wondered, like, gosh, when I was 20, I was able to buy that home. A 20-year-old today couldn't do that, but actually they kind of could. The difficulty is coming up with the down payment, right? But the actual cash flow to finance a loan that is twice as big as the loan that I was able to finance is still, it still kind of works out about the same. It's just because interest rates are so much lower, the bank will lend you that much more money. But your cash flows, your monthly mortgage payment, is actually possibly about the same, And so in many ways, I could say that he did very well out of the transaction, but equally I got to do other things with the money, and so everything kind of worked out, I guess. Anyhow, so swaps, because that's what we're here to talk about, not houses. They're not derivatives. The best known swap is what we call a plain vanilla swap. And the term plain vanilla is a term used a lot in finance, and it just sort of means the simplest one, or the most common one, right? Because when you go to an ice cream shop, they have a whole bunch of flavors, but probably half of the ice cream they sell is vanilla ice cream, right? So you'll hear people talk about plain vanilla options, or exotic options, or a plain vanilla swap, or maybe a more complicated swap. And so plain vanilla in finance just means the sort of most standard version. And the most standard version relates to trading fixed interest rates versus floating interest rates. And so in order to price a plain vanilla swap, all we have to do is present value these two cash flows. Now, you've taken a fixed income class already, or you know how to price bonds, right? Yeah. So when you're able to price bonds, you're able to present value these two cash flows, and therefore we know how to price this kind of swap. So in order for the swap to be valued at 0 at inception, so when we start out, the exchange is usually, it doesn't have to be valued at 0 at inception, but it's easiest if it is. And so usually swaps are valued at 0 at inception, and that just really means that the present value of the two cash flows has to be equal, and then we're able to exchange, we're able to enter into this swap without one party having to pay a sum of money to the other party, okay? So that is the swap at inception. Then as time goes by, interest rates will change and the swap will take on a value. Now swaps were first negotiated in the early 1980s, and so this is the best image I could come up with for the early 1980s, just for you guys. Look at that, the Apple computer logo there in the 1980s. Anyhow, first negotiated in the 1980s, they gave rise to the ISDA agreement, which stands for the International Swaps and Derivatives Association, which was sort of set up in order to deal with these swaps. And have you guys watched this film? It was a book by Michael Lewis, and the film is called The Big Short. Have you guys seen The Big Short? And so in The Big Short, there was a guy who was played by Brad Pitt, who helped some of the guys, because they came up with this great trade idea, but they weren't able to trade these over-the-counter derivatives, right? Because they needed an ISDA agreement, which is just an agreement with a bank to trade over-the-counter derivatives. And so that is the agreement that we're talking about. And it's actually quite difficult to get that kind of an agreement. So an individual almost can't get one. And for a hedge fund, it's actually a big part of launching your hedge fund is getting an ISDA agreement, getting a bank to agree to trade over-the-counter derivatives with you. And so swaps are a very large part of the derivative world, and probably the largest part by notional value. Now that doesn't mean by risk, but by notional value, they're huge. And that makes sense just because the notionals are huge on fixed income instruments. So swaps exist to take benefit from comparative advantage. So some companies might be better at borrowing, we'll say, at a floating rate, and another company might be better at borrowing at a fixed rate. Now that at first may not make sense to you, because you'd say, well, couldn't you just borrow however you want? And you would largely think so, but for example, if there's certain companies, there might be big companies that have been around for a long time, and they always just issue 10-year bonds. Like every year they issue a 10-year bond, and the old one rolls off, and they issue a new one, and that's just what they do. And the market is used to that, and the kind of person who likes to buy 10-year bonds likes to buy 10-year bonds from that company, and they know about it. So it might be complicated for them to borrow at a floating rate. Now equally, a bank, for example, we just talked about, that takes deposits from their customers, they're quite good at borrowing at a floating rate, because taking deposits just is borrowing at a floating rate, right? And so as you can see, there might be just different types of company that have different abilities to borrow. And it might make sense for them just to borrow, even if they want to borrow floating, but they're good at borrowing fixed. It might make sense for them to borrow at a fixed rate and then just to enter into a swap, which will essentially convert their fixed rate borrowing into floating rate borrowing, or vice versa. Does that make sense to you guys? Okay. So we draw up here a plain vanilla interest rate swap. And so this is a swap between counterparty A and counterparty B. We've drawn it as ice creams because it just makes it better that way, but you don't have to draw ice creams in an exam. Anyhow, we've got counterparty B is making fixed rate payments to counterparty A, and counterparty A is making floating rate payments to counterparty B. That's all there is to that swap. The only other thing we need is we need something that we call the notional amount, right? Because if we're saying that counterparty B is making fixed rate payments, if they're paying 4% every 6 months to company A, that 4% of what is kind of the question, right? And so that's what the notional amount is. It's the amount that that's calculated off of, right? So it's just a notional amount that the two interest rates that the payments are calculated off of. So the floating leg will often refer to Libor or or something like that. So in the future, when Libor goes away, it'll be a different rate that will be referenced in the legal agreement. So we'll say we've got two companies, they're called ABC and XYZ. Do you guys know why I picked those names for the companies? Well, every textbook has companies named XYZ and ABC, and I thought, why should I be different? But you guys would be happy to know that then I did Google around and I found logos for companies named ABC and XYZ, which makes it better, I feel. But anyhow, ABC and XYZ are able to agree to an interest rate swap. ABC is going to pay 4% fixed. XYZ will pay floating at Libor. We come up with a notional principal of 100 million, semi-annual payments, and a maturity of 3 years. So that's the details of this swap, okay? And there we go, we've got logos, so it's better, right? And the funny thing is, I had lots of logos to choose from because there's a lot of really unimaginative people out there who just name their company ABC. They're like, we'll call it ABC, but let's come up with a good logo. You know, I don't want to have a rubbish logo, but it doesn't matter what we call our company. Anyhow, so ABC is going to pay fixed, XYZ is going to pay floating. The notional amount's 100 million, semi-annual cash flow is at 4%, maturity is 3 years. So we don't know who's going to win because one of these things is variable. The floating rate is going to change and we don't know which way it's going to go. We do know there are 6 cash flow exchanges and that at each point ABC will be paying $2 million to XYZ. Where are we getting $2 million from? It's 4% and it's semi-annually compounded, so we're able to just divide it in 2, and then 2% of 100 million, the notional amount, is $2 million. So we know the fixed leg, the only thing we don't know is what the floating leg will be. So if we move forward in time, we're then able to see who won, right? So at inception, it's equal, but as time goes by, we work out what happens. So here we go. Period 1, 3.2%, then 3.7, then 4.2, 4.4, 4.5, and 4.8%. And so we're able to then work out what the cash flows are. The fixed cash flow is always 2 million. This one starts out at 1.6, then 1.85, 2.1, 2.2, 2.25, 2.4 million. At the very end, we have net cash flows exchanged. And so if you just sum those all up, that tells us who paid who the most money over the life of that swap. Okay, so that's just how a swap will work out over time. Are we all happy with that? Okay. So the notional amount, it's worth noting, doesn't change hands, right? And the reason it doesn't change hands is it wouldn't make sense if one company wrote a check for 100 million to the other and they each wrote the same check to each other. It doesn't need to change hands. It's just the amount that we calculate these interest payments based upon. So the interest rate swap allows investors to do the same sort of thing. It changes borrowers from fixed to floating or vice versa. So it allows people to choose to either be paying fixed or to be paying floating, or to be receiving fixed or receiving floating, right? In our example, ABC switched its borrowing from floating to fixed, and XYZ switched its borrowing from fixed to floating, okay? So that's what the swap did. We'll now take a quick break. Let's see how much time. We'll take about a 5-minute break, and we'll come back and learn more exciting things. Okay, so let's continue on. So, in the real world, big companies typically don't transact with each other. They don't seek each other out and sort of find, the big companies don't find each other and say, I'd like to borrow fixed and you'd like to borrow floating and we'll work it out. That's not the way it works. It might have worked that way early on, but rather quickly banks came in as a middleman. And at first, banks would have matched counterparties charging a fee, and then as the market grew, the market became hugely liquid, and there's a mix of hedgers and speculators in there, and banks were just able to act as a market maker and basically charge one price that they'd buy and one price that they'd sell at, and that's the way it works now. So the spread, the difference between what the bank will buy and sell at, is firstly, it has to compensate them for the risk they're taking by being in the middle of these things. And secondly, it has to provide a profit because they're not doing it, not to earn a profit. So in the real world, instead of having ABC dealing with XYZ, what we have is ABC dealing with the investment bank and XYZ dealing with the investment bank. And I can tell that you guys are all happy that I did find a logo for iBank. Anyhow, so why enter into swaps? So one reason to enter into swaps is just that it allows you to convert your floating rate loans to fixed or vice versa. The other reason is simply to speculate on the direction of interest rates, right? Because if you think interest rates are going up, you might want to be paying fixed, while if you think that interest rates are going down, you might want to be receiving fixed. So you're able to not just not just hedge, but you're able to speculate. You're able to bet on the direction of interest rates by entering into these swap contracts. Does that make sense? Okay. So one counterparty. So why enter into swaps? Another reason is that one counterparty might be able to get a better rate in the fixed rather than the floating market, or vice versa. We sort of talked about that already just a few minutes ago. And that the two companies then can split the difference, entering into swaps and convert their borrowings. So that's another thing that could happen. That then brings us to this law, Ricardo's law. You guys have taken an economics class, right? And you've heard of Ricardo's law of comparative advantage. And it's sort of an idea from economics relating to international trade. So the law of absolute advantage is that if one company is better, or one country is better than another country at producing one good, and the other country is better than the first country at producing the second good, they should each specialize and produce as many of the goods as they can and just trade with each other, and that tends to work out better for everyone rather than them all producing a little bit of the good they're good at making and some of the good they're bad at making, right? That's the law of absolute advantage, when one country has an absolute advantage over the other and vice versa. The law of comparative advantage tells us that even if one country is better at producing all goods, they should still focus on the good that they're best at producing and buy in the good that they're second best at producing. And the reason for that is, once again, there's just more goods produced and everyone is better off. And that's sort of a slightly counterintuitive law of economics that all of international trade is based upon. And so most economists think of that as a fairly basic idea. Politicians, of course, don't understand it at all, and that's why we're constantly in these sort of trade wars with tariffs and things like that. But generally, this makes sense. So what we have here is we're going to apply that law, or that idea, to the world of interest rates and swaps. So if we've got one company who has better access to the capital markets than all others, it might still make sense for them to enter into the swaps market, okay? So we're going to work through an example of this. Now, this is the kind of example, I'm going to ask you guys to all focus a little bit on this, because it's kind of a complicated idea. It's actually a very simple calculation once you see what I'm doing, but people often struggle with this question. And is anyone here doing the CFA exam this year? We've got quite a few. Okay. This question comes up all the time on the CFA exam as well, so it's kind of it's a pretty standard sort of question around swaps. So let's have a look at this. We've got two companies here, Company A and Company B. Company X and Company Y, of course, different companies. And Company X, as you can see, is able to borrow 3.5% in the fixed rate market. Company Y can borrow 4.5% in the fixed rate market, okay? So Company X has an advantage in the fixed rate market. Now in the floating rate market, Company X will borrow at LIBOR minus 0.2%, while Company Y is borrowing at LIBOR plus 0.4%, okay? So once again, Company X is able to borrow at a lower rate. So you'd look at this and you'd probably say, Company X just needs to do their own thing, there's no benefit to getting into a swap, okay? But let's see if there's something we can work out here. So let's firstly look at it and we'll say, what is the difference between 3.5% and 4.5%? It's 1%. What about LIBOR minus 0.2 and LIBOR plus 0.4? 0.6%, right? So while they're better at both things, they're much better in the fixed rate market than they are in the floating rate market. They have an absolute advantage in that they're better in both markets, but they're much better in the fixed rate market, okay? Now, if they wanted to borrow in the fixed rate market, they'd just borrow in the fixed rate market. It's that simple. But we'll say if they wanted to borrow in the floating rate market, and company Y wanted to borrow in the fixed rate market, we're now able to come up with a swap that will work for them. So there's 1% advantage in the fixed rate market, but only a 0.6% advantage in the floating market. Where do we go from there? So if company X prefers to borrow floating, and company Y would prefer to borrow fixed. Now they have to want to borrow in a different market than the one that they're best at borrowing in. They could decide to split the difference between each other. So what is the difference? It's 1% minus 0.6% gives us 0.4%, okay? Now in the question it states that they're going to split it evenly between themselves, okay? So we know that. Now in the real world, maybe they would want to, company X might say, well, we're bringing everything to the table here, we should take most of the gain. But in this question, they're splitting it evenly, okay? So we've got 0.4%, which is just the difference between 3.5% and 4.5% being 1%, and LIBOR minus 0.2 and LIBOR plus 0.4 being 0.6%. The difference between those is 0.4%, and they're going to split this evenly between each other. So, how much better off is each of them going to be? Well, what's half of 0.4%? 0.2%, okay? So we know this, okay? This is where people often get confused. We do know this. We know that each of them, they're going to get to borrow the way they want to, and they're going to be 0.2% better off. So, what we need to do is we need to work out this swap. So, we start with what we know. We draw our boxes, company X, which of course has a logo, and company Y, and they borrow in the market that they're best at borrowing in. Not the market they want to borrow in, the market they're best at borrowing in. So company X is going to borrow 3.5% in the fixed rate market, and company Y is going to borrow at LIBOR plus 0.4%, okay? And that's just these two rates here. And they borrow where they're best at borrowing. And then we enter into a swap. And our swap is going to make each of them how much better off? 0.2%, okay? So, that means we actually know. So company X here, we can solve this from either side, okay? And the trick to this is just look at the side you're solving from. Don't worry about the other side, it'll kind of all work out, and we'll see that in a moment. So we know that company X wants to borrow in the floating market. We know that they can borrow at LIBOR minus 0.2, but they're going to be 0.2 better off, so they're going to borrow at what? LIBOR minus 0.4, right? Because that's minus 0.2 plus minus 0.2, right? So LIBOR minus 0.4. So we know they're borrowing at 3.5% fixed. We put LIBOR here at the bottom just because it makes it easier to do this calculation, right? We don't put LIBOR plus 0.4 or LIBOR minus 0.2. We just put LIBOR at the bottom, okay? And then we see how much has to come in order to get them to borrowing at LIBOR minus 0.4, okay? So if 3.5% is going out, we need 0.4 more to be coming in order to be borrowing at LIBOR minus 0.4, right? So 3.5 plus 0.4% is what? 3.9. So if we put 3.9 in there, that means that 3.9 goes in, 3.5 goes out, which means 0.4 is captured in the box there, and then LIBOR is going out, and that means that they are borrowing at LIBOR minus 0.4. Does that make sense to you guys? Does that add up?
No, it doesn't.
It doesn't, and don't worry, because I'll tell you, every time I teach this, I go through it about 4 times, okay? So guys, don't tell me you get it if you don't get it, because I'm happy to just do it again. So, let's solve it this time from this side, because it doesn't matter which side we pick, we just pick a side and we go with it. So, company Y, we're going to have them borrow at LIBOR plus 0.4, and that's just the rate they're able to borrow at, right? That's their borrowing rate. And we're going to have company X borrowing at 3.5, which is where they have this comparative advantage. So, same as before, we know what's going out, and we're going to put LIBOR at the bottom, and we just have to work out what goes at the middle there. We just have to work out the fixed rate, okay? So, from company Y's perspective, they want to borrow in the fixed rate market, right? And what rate are they able to borrow at in the fixed rate market? 4.5. But we know, because they're splitting this 0.2, that they're going to be 0.2% better off, right? So we know we're going to get them to 4.3%, okay? We do know that, and that's just 4.5% minus 0.2%, which is what these two companies have agreed to split between themselves, okay? So we need to get company Y to borrowing at, what did we say? 4.3%, right? So they're paying LIBOR plus 0.4, that's going out. LIBOR is coming in, right? So LIBOR comes in, LIBOR and a bit more goes out, right? So now the fixed rate here needs to be added to that extra amount that's going out over there and sum up to 4.3%. Do we agree with that? So 4.3% minus 0.4% is what? 3.9%, so we put that in there. Does anyone get this or not yet? We've got a few people saying yes. Don't worry, if I'll tell you, every year I teach this, I have to kind of revise it a bit first because I don't want to explain it wrong, okay? So, all that's happening is, we've got the difference between the rates, right? The difference between 3.5% and 4.5% is 1%. The difference between LIBOR minus 0.2 and LIBOR plus 0.4 is 0.6%, okay? 1% minus 0.6% is 0.4%, right? We then divide that by 2 because they're each going to be better off by that amount. So that's where we get our 0.2%, right? Then we're going to have them borrow in the market where they're best at borrowing and swap into what they want. So we know company X is 1% better at borrowing here, so we're going to have company X borrow at 3.5%. We're going to have company Y therefore has to borrow at LIBOR plus 0.4. That's what they're going to borrow at, and that's just the market rates that they're going to get. Then they have to enter into a swap, and they have to each be 0.2% better off, okay? Does that make sense? So, we're going to enter into a swap. So, we write here what's going out of each company, and that's just the rates they have to pay on the loans that they're best at borrowing at, okay? We then put LIBOR at the bottom, and that's just because it's easier to put LIBOR at the bottom, okay? So we have LIBOR coming from company X to company Y. So which side do you guys want to solve it from this time? X. So we'll solve it from X. So if company X has 3.5 going out, and they've also got LIBOR going out, they need a fixed amount to come in that gets them to LIBOR minus 0.2 minus 0.2, which is LIBOR minus 0.4, okay? So in order to get, well, we know LIBOR is going out, so we basically need 0.4 more to be coming in than is going out, and that will mean that they're borrowing in LIBOR minus 0.4, they're borrowing below LIBOR. Are we happy with that? So, therefore, if 3.5% plus 0.4, because we need 0.4 more than that, is 3.9%. If 3.9 goes in and 3.5 goes out, and also LIBOR goes out, that means that they're borrowing at LIBOR minus 0.4, so they're 0.2 better off. And it just so happens that that rate works for company Y. It gets company Y borrowing 0.2 better than they would be otherwise. Are we okay with that?
Yeah.
Shall I solve it from company Y side just for completion? So, and then there is a YouTube video that covers this, you know, so and this same example is in your book, so it'll all work out. So let's see. Company Y and company X, we put in what they're actually borrowing at, which is the rate that they sort of have a comparative advantage at. We put LIBOR at the bottom. Now we need to get company Y to be borrowing at 0.2 better than 4.5%, so 4.3%, right? Now, this time LIBOR is coming in and LIBOR is going out, right? So LIBOR cancels out there. It's coming in and going out. It doesn't matter. But a bit more is going out, right? 0.4 more is going out than is coming in, right? So that means if we had 4.3 up there, they'd actually be paying 4.3 plus 0.4, right? Because there's sort of leaks in both directions, right? We need to make it that the total number that's going out is 4.3. So if 0.4 extra is going out here, we know that. We just take 4.3, subtract that 0.4, and that gives us 3.9%. So if they're in this swap, receiving LIBOR and paying 3.9% fixed, that means that company Y is borrowing at 4.3%, and it means that company X is borrowing at LIBOR minus 0.4%. Does that work? Everyone's nodding. Okay, I think you guys all get it. If you don't, there's another video on YouTube you can watch that works through this. There's your book which works through this. And in all honesty, it's one of those things, like it's a horrible looking question at first. Like I used to hate this kind of question. It looks horrible, but once it's kind of addition and subtraction, right? Once you just work out where the cash flows are going, and the big thing is just knowing that the difference between these, 1% and 0.6% is being split into, once you know that they're each going to be that much better off, then you just have to solve to get that. And a few years ago, I think I did have an exam question like this where I put a bank in the middle as well. So the bank was taking a little bit out, and then all you have to do is reduce by the amount the bank takes out, and it still works out, okay? But this is the kind of a swaps question. I don't know what's on the exam this year because I wrote a whole bunch of exams and don't know what's on any of them. But it's the type of question that sometimes does come up on exams, and it's not that hard if you've prepared for it. Now, if you walk into an exam and you haven't prepared for it, this is a bit of a nightmare, right? But I think most of you guys have it sort of clear in your heads. If you just sit down and play around with it, when you get home, you'll find it's not that bad a question at all. So that is comparative advantage in swaps. So, what else have we got? So, valuation of swaps. So they're valued at 0 at inception, okay? They're worth nothing to begin with. We just find the rate at which they're valued at 0, and that's the fixed rate. They're valued at 0 at inception, and then as the floating rate changes, they take on a value, a positive or a negative value, depending on which side you're on. So if you're receiving fixed in a swap, the value of the swap is the present value of fixed minus the present value of floating. If you're receiving floating, it's the present value of floating minus the present value of fixed, okay? Now, we don't even have to really memorize that, because it's just, let's think about it. It's the present value of what you're getting less the present value of what you're paying, right? So on the 2 paychecks example, it was the present value of what you're getting, which is the other person's paycheck, less the present value of what you're paying, which is your paycheck, right? And so that's the value of the swap. So it's just about discounting these 2 cash flows and working out which one you're paying and which one you're receiving, and that will tell you what the swap is worth. Are we happy with that? So therefore, if we're able to value 2 bonds, and one's a fixed rate bond and one's a floating rate bond, and we know which one we're receiving and which one we're paying, we're able to work out the value of the swap, okay? Now we've got 2 ways here that we're going to look at valuing a swap, but this all just comes down to that. I don't enforce a way that you value these, okay? If you have your own way, use it, because it's really just present value and cash flows, okay? And so if you're good at bond mathematics, however you price these bonds, there's always a few ways of doing it. Do it your favorite way. Like, I'm not going to tell you which is the best way, because they're all mathematically identical. But, so the two ways we're going to look at in class right now are valuing the two legs as the present value of floating rate and fixed rate bonds, or valuing the swap as a portfolio of forward rate agreements. Now, in truth, I find the first one sort of sits better in my head, like I can just really get that. The second one is, in my opinion, a little bit more contrived, but that's just me. You guys might prefer the other way around. So as far as I'm concerned, do it however you like. But we're going to use both methods to value the same swap here, and we'll of course get the same answer. So a swap has been around for some time, and we want to value it. And the swap is that you're paying 6-month LIBOR floating versus 5% fixed, semi-annually compounded. The notional is 100 million. There's 1 3/4 years remaining. LIBOR continuously compounded is, so there's a bunch of different LIBOR rates. 3-month LIBOR is 6%, 9-month LIBOR is 6.5%, 15-month LIBOR is 7%, 21-month LIBOR is 7.3%. So there's different LIBORs for different expirations, okay? 6-month LIBOR, the last payment date was 6.2%. What's the value of the swap? Now, there's a few things we have to look at, because I've made this question a little bit harder than it needs to be, and that's just so we can learn as much as possible when doing it, okay? So, why did I have 1 3/4 years remaining? Why did I do that? To make it harder, okay? Because what's that telling us? It's semi-annual payments, but there's 3/4 of a year remaining. That means we're right between two payments, right? We're 3 months away from the next payment, and we've just passed the last payment by 3 months, okay? Now, the other thing we've got up here is LIBOR, the last payment date was 6.2%. Why do we care about that? Well, the way swaps work, and I don't think I mentioned it earlier, but how it works is just to give everyone time to organize themselves. What we do is we observe the floating rate at the last meet-up period, the last exchange, and then we decide on what the payment will be at the next one, right? So it's always sort of a lagging version of LIBOR, okay? And that's a real-world thing. Now, the next thing we have up here is 6-month LIBOR at the last payment date was 6.2%, okay? Now, the reason we need to know that is the way swaps work. In order to give people time to arrange the cash flows, they agree to always pay, they observe LIBOR at the last payment date and pay it at the next one, right? So there's always this lag in the floating leg of the swap. So they've observed that LIBOR at the last payment date was 6.2%, and that means that is the rate we're going to base the next exchange of cash flows upon, okay? So there's always that lag. Now, let's look a little bit at this question and just work out what's going on here. So, why is it 1.75 years remaining? The reason is just to make the question more complicated, okay? And what we're really saying here is that we are halfway between payment dates, right? Because they're semi-annual payments and there's 3 months to go. So we're at the midpoint between two payments on this swap, okay? We know that the next payment is going to be 6.2% on one leg versus, what was the fixed rate? 5% on the other leg of the swap, okay? We do know that, and so that's kind of what's making this question a bit harder than it might normally be. So, what we do is we draw a little box like what we've got up here, and we've got here our fixed cash flow, so 2.5 million, 2.5 million, 2.5 million, and then 102.5, okay? The reason we put it as 102.5 is just because we're pricing it like a bond, okay? So we put in principal and interest there at the end, so 102.5. So that is the fixed bond cash flows, and then we've got to calculate the floating one, which is kind of where the complexity comes in. Now, what we have to remember at this point is how do we value a floating rate bond, okay? Now, if I admit, this question, the reason I had to put it between two payment periods is it would be too easy if I just did it at a payment period, because does anyone know, after a coupon is paid, what does a floating rate bond become worth? It basically always resets to being worth $100 per 100 of the loan, right? It goes to par value as soon as the coupon is paid, okay? So the only way to make it complicated to value a floating rate bond is to be between the two payments. And then all we have to do to value our floating rate bond is we have to look at that 6.2 cash flow, and we're going to receive half of 6.2%, which is 3.1%, in 3 months' time, but we're going to have to discount that at 3-month LIBOR, which we now know is 6%, okay? So what we've got here is 100 million plus 100 million times 6.2% over 2, which is 3.1%, gives us 103.1 million, okay? Now we have to discount that, we have to present value that. So we calculate a present valuing factor here. So that's just e to the 6%, which is the rate of 3-month LIBOR. I apologize for the fonts on this, it's impossible to read. E to the minus 6% times 3 over 12, because it's 3 months out of the year, okay? So we do that calculation, and that gives us 0.9851, okay? We create similar discount factors for all of the other LIBOR rates that we had, right? Which were, what did we have here? 6.5%, 7%, and 7.3%. So we do the same calculation for each of those, and we come out with all those different discount rates, right? So to present value the fixed bond, we multiply our 2.5 million by 0.9851, and that gives us 2.4628 million, okay? We take the next 2.5 million and multiply that by 0.9524, and we get this number. And we take the next 2.5 million and multiply by 0.9162, and so on, okay? And so we get all of these present values of the various coupons, add them all up, and that gives us the value of that bond, okay? That's how we value the fixed bond. Floating bond, a lot easier. We just take that 103.1, multiply it by 0.9851, and we get 101.5650, and that's the value of the floating rate bond, okay? And then the difference between these, it depends if you're paying floating or paying fixed as to what the value of the swap is. And in our example, we must be paying floating, and so the swap is worth minus 4.22 million, which is just the difference between these two numbers. Does that make sense to you guys? So it's just present valuing the two cash flows, right? And that is the value of our swap.
Does the stream of floating payments assume that the LIBOR stays at 6.2%?
Well, what happens after that, you see, once one cash flow has occurred, after that it's always a floating rate been discounted at a floating rate, which sort of cancels itself out. So as soon as, if you look up the pricing of a floating rate bond, as soon as a coupon is paid, a floating rate bond resets to par value, or $100, and then as time moves on, it takes on a new value until the next coupon is paid, and then it once again resets to being worth 100.
Is that because you can pull the 6-month rate in 3 months' time using the forwards that were given in the question?
Exactly. What's happened to make this bond take on a value is just that rates have moved down over this period. So the 6.2 has moved down to 6% basically, and that's causing the, or actually it could still be 6.2, but it's because we're discounting 6.2% at 3-month LIBOR, which is just 6%, right? So that's all there is to it. So that is how we price a swap. Now, The next example we'll look at, it's in the book, and it's really just there to sort of show the use of forward rate agreements. In truth, I don't enjoy using, like if I had to price a swap, I wouldn't use this method, but I'll show it to you guys. So we do the same thing where we put together a table just like before, and we write down our fixed cash flows, which are the same as before. They're just 2.5 each at each period. We're not doing the 102 because we're not pricing it as a bond, right? So we've got 2.5 at each period, and then we calculate these forward rate agreements. So FRA continuously compounded is calculated here, and then we convert it into semi-annual compounding in order to make it comparable to the fixed cash flow. Then we look at the difference between them, and then we multiply them by the discount factors, which are the same discount factors that we calculated in the last example, okay? So, what are we doing here? So we take our 2.5 millions, and we can multiply all of them by 0.9851, the next one by 0.9524, the next by 0.9162, and the last by 0.8801, and that's how we deal with the fixed cash flows. The floating ones, a bit more complicated. So we've got here 6.5% times 0.75 minus 6% times 0.25, all divided by 0.5 gives us 6.75. So what we're doing is we're calculating that 3-month forward rate for out of the two rates that we have, which are 6.5 and 6%, right? And so it's down to the length of time. So 3/4 of the period is 6.5%, minus 6% times 0.25, and that gives us 6.75%, but that's continuously compounded, so we need to convert that continuously compounded rate into a semi-annually compounded rate, and we do that by calculating 2 times the square root of e to the 6.75, which is what we just calculated there, minus 1 gives us 6.87%, okay? So we've gone from continuous to semi-annual compounding there. We do the same with each of our rates, and then we look at the difference between the cash flows, and then we present value them by multiplying by these discount rates, sum them all up, and that comes to minus 4.2232 million, which is the same number that we calculated before. So that's two ways that we can price a swap. I don't insist on, I don't really care how you price a swap as long as you can price a swap. So you can pick which way you find most attractive. And so that is the FRA approach. So that's us done with interest rate swaps. And that's kind of the complicated questions, which is price the swap or work out that comparative advantage argument, right? The next thing we're going to talk about is currency swaps. And a currency swap, the purpose of a currency swap is to transform the borrowing currency from one currency to another. So you can probably imagine, it makes a lot of sense, that there might be one company that's good at borrowing in a given currency and another company that's good at borrowing in a different currency, okay? But if they wanted exposure to the other person's currency, it might be difficult for them to borrow that way. So we'll say, for example, if you have BMW and they decided that they want to open a factory in the United States. Well, in order to build a factory and to hire people and all of the stuff involved, they would need US dollars, right? But BMW is a German company and they usually borrow in euros, right? Now, it might be complicated for them to borrow in US dollars, so it might be easier if they just borrowed in euros and then swapped into US dollars. Does that make sense? So we can do that. So what happens in this example, though, with a currency swap is that they do exchange principals to begin with. And that's quite simply because if you're trying to borrow in US dollars and you've borrowed in euros, you want the US dollars, right? So it makes sense in this case for them to exchange currencies at the beginning, and then again at the end they'll exchange back. And so the principal amounts exchanged are exchanged at the beginning and the end of the swap, and the amounts are chosen such that they're equal to begin with, and then we can swap without one side having to pay anything to the other. So how can we do that? Well, let's say we've got a 4-year agreement between USA company and Brit company. USA pays 3% fixed in pounds and receives 4% fixed once again in dollars. So this is a fixed for fixed currency swap. So we don't have to worry about the fixed versus floating thing here. The only thing that's going to change is the exchange rate, right? So there'll be one interest payment per year in this swap. Principal amounts are $15.2 million or £10 million. And basically this is an older question. It'll be whatever the interest, or whatever the exchange rate is right now, obviously, okay? And so that could be our swap. So when we put it all together, you can see that at year 0, they exchange those principal amounts. That's the first thing, is they just exchange the amounts. And then after that, they exchange the payments, which is always the same. $0.61 million for 0.3 million pounds. And so they exchange these at each year up until the end, when they exchange both one of these coupons plus the initial amount back. Okay, so they exchange the pounds and the dollars back once again. And that's all a currency swap is. Do we understand that? So that would make sense. It's just not very complicated. And in order to reprice it, the thing that's going to cause the value to change is just if the exchange rate changes over the life of the swap, right? So we can have fixed for fixed foreign exchange swaps, and we can price them using 2 bonds or a portfolio of forward contracts. So the same sort of idea for pricing it this. And if we're using the bond valuation method, it's local currency received, the value of the swap equals BD, which is the bond value with domestic cash flows, minus the exchange rate times BF, which is the foreign bond with foreign cash flow. So that's all we need to do in order to price one of these. Credit risk on swaps. So of course there is credit risk on these, in particular with you know, who your counterparty on the swap is. Now over time, there's a move to getting more and more derivatives being centrally cleared. And so that will eventually happen where there's a clearinghouse for everything, but it's not fully there yet. And so the over-the-counter nature of these means that you have to worry a bit about who you're exposed to. For example, if you were exposed to Lehman Brothers and they owed you money, there's a problem because Lehman went bankrupt in 2008, right? So, and Bear Stearns as well. This was a big problem at the time, unwinding all of these swaps. In fact, I think it's possibly still going on. Variations on these. So we can have interest rate swaps on non-LIBOR rates. We can have the principal amortizing over time or increasing over time, right? You can do whatever you want to make these more or less complicated, you know, because it's just 2 cash flows, and we can make the cash flows as complicated or as uncomplicated as we want to. We could have a currency swap that's fixed for floating or floating for floating, you know, so you can make it complicated. You don't have to, but you can. What else have we got? So then here's a good one here. This is an equity swap, which is an agreement to exchange the total returns on a portfolio of stocks, so say something like the S&P 500. We could swap that for the returns on a portfolio of bonds, right? And so if you owned a portfolio of stocks and you entered into this swap, you would end up with the exposure as if you owned a portfolio of bonds, right? And so we're able to, any 2 cash flows, we can just swap one for the other. Now, we have an example here of a type of swap that used to be a big thing about 20 years ago, which was this idea of taking people out of their stock and diversifying them. So there were often people who were exposed to, they happened to own a very large, a large amount of their wealth is tied up in one stock, okay? And that happens to a lot of people. We'll say if you founded a company, if you're Jeff Bezos, all of his wealth is tied up in Amazon stock. Now we all know in finance that maybe someone wants to be diversified, right? Because the whole idea of diversification is that you get hopefully the same return but with lower risk, and that relates to the correlation of the securities in the basket, right? So the individual stocks in the S&P 500 will all have, or will on average have higher volatility than the S&P 500 as an index. And the reason that the volatility is muted is simply because of the lack of perfect correlation between those stocks. So that is how diversification works. So in the late 1990s, there were often people who had this huge exposure to these dot-com stocks, you know, the technology stocks at the time. And these stocks had gone up an awful lot in value, and there were people, and they had, we'll say, in this example, a guy who had $85 million of stock in a company that was called CMGI. And the problem with this is that CMGI, it was the best returning stock of the 1990s, okay? It was a huge return. Does anyone know what CMGI is today? No, it's kind of disappeared. But what it was it was called an internet incubator stock, and that was really hot. And it basically, they were kind of like, they invested in a whole bunch of internet stocks, right? And they all went crazy at CMGI stock price did. And so this guy went into his bank, and he had $85 million worth of CMGI stock. And the bank said to him, well, what we can do is there's all these technology mutual funds, and they actually want to have CMGI in their portfolio, but they're having a hard time buying it, right? And so we can put you into a swap where you give the returns of CMGI to, we'll say, a mutual fund or a hedge fund or someone like that, and they give you the returns of the S&P 500. So straight away, you are diversified. You've gone from having all of your eggs in one basket to a diversified basket of stocks, right? So now, a lot has changed since the 1990s. At the time, I think this has now changed, that also would not have been taxable, right? If he had sold his CMGI, he would have had to pay capital gains tax at a rate of about 40%, okay? Entering into a swap because he hasn't sold his stock, he wouldn't have had to pay capital gains tax, right? So he gets diversified without being hit by taxes, which I think, does everyone like that? We're all happy with that? Mm-hmm. Right. So there's no Bernie Sanders voters here at all. Bernie Sanders hates this. But anyhow, so the client decided that he didn't want to do this, and the reason he didn't want to do this was the CMGI was such a great stock that obviously $85 million of CMGI was worth way more than $85 million of the S&P 500, right? Because CMGI was going up at like 10 or 20% a day back then, right? And the last thing he wanted was to give up his really good stock and get a basket of stocks that aren't as good, and then he'd look like a fool when he went into work because everyone at work had doubled their wealth in the last week and he was up 0.5% or something like that. So he declined to do that, and as you can see, there's the chart of CMGI. It went way up and way back down again, kind of disappeared. And so, to a certain extent, he probably should have done this transaction because maybe you don't always get, the guy would have been about 25 years old. Often you don't get to be worth $85 million at that age. He did. He doesn't anymore. So, what price should it be worth? The answer is that they did give him a fair deal. Now, it's kind of down to that idea of, you know, that people sort of ask that joking question, which is heavier, a ton of feathers or a ton of steel? And the answer, of course, is that they both weigh a ton. They weigh the same, you know. And that guy, didn't realize that $85 million of the S&P was worth the same as $85 million of his stock. And so it was a fair deal. Now, what else can we do with swaps? We can embed options in swaps, right? We can make a swap extendable, where one party has the right but not the obligation to extend the life of the swap if it's favorable to them. We can make it puttable, where one party has the right but not the obligation to terminate the swap early if it's favorable to them. We can make swaptions, which are like an option where the underlying is a swap, okay? Do you guys know how to price those things? You don't think you do, but you do, right? Because you know how to price options. We've just done an exam on that. You all did well on it, hopefully. So you know how to price options. You know how to price swaps. And so if I gave you enough time, you probably couldn't answer me quickly, but I bet if I gave you guys an hour or two, you'd work out the answer to how to price any of these, okay? And that's kind of the purpose of this class, is we're trying to learn not just a bunch of formulas, but we're trying to learn a toolkit of how these things work. So you actually all know how to do this. You can price these things. You just have to think about it for a while. So what else can we swap? We can have commodity swaps, where we're swapping the return on a basket of commodities for the return on something else. We can have volatility swaps, or we can have dividend swaps. And so we're going to talk about the next two things because they're quite interesting. So a volatility swap is usually structured as a variance swap. So we're going to swap the variance on something for the implied variance on that thing. Now, why are we using variance? The reason, normally when we talk about volatility of a stock, for example, we usually are talking about standard deviation, right? Now the problem is that standard deviation is the square root of the variance, and that square root thing makes it very hard to hedge, okay? So it's easier to hedge the variance than it is the standard deviation, and so the swap is built around variance rather than standard deviation, but it's a similar idea. So if you wanted to take views on an asset's volatility as opposed to its underlying price activity, you could enter into one of these swaps. Now, does anyone know another way that you could do this? What did we learn in our recent classes? We learned about dynamic hedging, right? If you want to go long or short the volatility of an underlying, you can trade, you can buy or sell an option, and then you'll delta hedge it, and you'll get either the difference between realized volatility and implied vol, or the other way around, right? So a variance swap sort of does that for you, okay? A variance swap, the payout is, Barclays were the big bank in terms of variance swaps, so that's why we have them up here. Barclays would pay you the realized variance times a notional principal, and you would have to pay them the strike variance times a notional. So the strike variance would be kind of like the implied volatility in the market. So if you thought it was going to be more volatile than the market thought it was, you would buy variance. If you thought it was going to be less volatile, you would sell variance, okay? Now, what do you think Barclays are doing in the background in order to hedge this? They're trading a whole bunch of options against the underlying. They're delta hedging a whole bunch of options in the background. In the book I explain it in more detail, but in the class we'll just explain that there's that delta hedging trade going on. Now, years ago, they used to do this on both index and on single stock. You could buy or sell single stock variance. After the credit crunch, during the credit crunch, they stopped doing this. And the reason for that is the smile, okay? Because when you're hedging one of these, you have to trade a whole bunch of options, right? And the smile is going to play into the pricing of this. And what happened was, because the market was moving much more than anyone thought it would move, it was moving off of the smile, right? It was moving past the prices that there were available options at.
So is Barclays going to charge a premium to enter into the swap, or are they going to adjust the strike that you can exercise out?
Well, they would just charge a premium, and it's based on essentially the cost of them providing this service to you plus a profit, right? And so they are going to, they will have a different implied variance than the implied vol would imply in the market, and that's just simply because they're doing a lot of work for you, right? It's the difference between sort of buying all of your ingredients at the supermarket and going home and cooking a nice meal, or getting it made for you at a restaurant, right? So Barclays with your restaurant, they do all of this for you, but they do charge you more to do that. So long vol payoff, you get realized vol minus strike vol times whatever notional you pick. Or short vol, you'll get strike vol minus realized vol times whatever notional you pick. So that is a variance swap. The next one we have is last derivative of the day is a dividend swap. And dividend swaps are things that have appeared because investment banks do such a business in derivatives, okay? And so they're trading all of these options, and as we've learned up until now, dividends aren't built into our options, right? If you own derivatives, you don't receive the dividends, but if you're hedging the derivatives, you're often trading the underlying against your derivative, and so you're exposed to dividend risk, right? And so banks wanted to get rid of that dividend risk, and so they came up with dividend swaps. And we'll say, for example, on something like the Euro Stocks index, you're able to go long or go short dividends. And that basically means that there is an implied level of dividends in the index. So we'll say people think that the Euro Stocks index is going to realize 3% dividend yield over the next 5 years, and you think it's going to be higher, you could buy a dividend swap, and so you'll pay the strike, which is the 3% dividend, and you will get whatever dividends the Euro Stocks index actually pays. And so often these things are even sold cheaply by the banks simply because the banks want rid of this risk exposure. So for each period, if you're long dividends, you get realized dividends minus strike dividends times whatever notional amount you chose. Or if you're short dividends, you get strike dividends minus realized dividends times whatever notional. So once again, it's just a swap. It's just two cash flows being exchanged for each other. That's all it is. And so that's our final slide. Have a great week, guys, and I look forward to seeing you next week. Bye.